It is hard to remember a time when environmental, social and governance, or ESG, investing was just a minor subset of the investment world, which wasn't spoken about a great deal due to a general lack of interest from the wider market. The combination of several factors, including an increase in knowledge and awareness of the environmental, social and governance challenges across the world, and an expanding universe of options available for investors to choose a more sustainable investment approach, has led to the huge amount of progress that's been made in moving ESG from a niche to a mainstream form of investing. ESG integration has gained momentum as investors have recognized its use as a vital risk mitigation tool as well as a source of alpha, and as the uptake has increased, so has the fear of being left behind in this drastic shift towards making sustainability the new standard of investing. Despite the rapid progress that has already taken place, we are still very much at the foothills of a green revolution. So, whilst it has come a long way since its origination, the question is, what lies ahead for ESG investing, and will it continue on this rapid growth trajectory? Before we look at what the future holds for ESG investing, it is worth taking note of where it has come from. Whilst ethical investing dates back to the 18th century, with religious establishments being the first to incorporate their religious and moral views into their investments, it has grown considerably since then, and a large amount of this growth taking place since the turn of the millennium. Many significant milestones were achieved in the last 20 years, including the development of the United Nations Principles for Responsible Investing in 2006, which was the first formal strategy for incorporating ESG considerations into investing, creating an international network of signatories willing to work together to implement the 6 principles outlined to create a more sustainable global financial system. This set the ball rolling for what was to come, as soon after, the United Nations developed the 17 Sustainable Development Goals to tackle issues such as poverty, climate change, and inequality across the world, with a target to achieve these goals by 2030. It was estimated that it would require 2.5 to 3 trillion US dollars of investment per year to achieve these goals, and whilst a lot of progress has already been made, there is still a decade's worth of investment needed to achieve them all by 2030. Which means more opportunities to invest in companies that will be able to transition at a faster pace and operate more successfully overall in a sustainable world. The momentum towards ESG investing has picked up pace in more recent years, particularly 2020, which was a record year for inflows into responsible investments, a stark contrast to the outflows experienced by traditional equity markets. 2020 was a significant year in terms of the progress that was made in all areas of ESG, including the environmental, social and governance aspects. We know that crises tend to accelerate trends, and the upheavals of the year undoubtedly helped to propel an already growing trend towards ESG investing, as it gave investors a heightened focus on sustainability and a wake-up call to the dangers of not considering unforeseen risks closely enough. Whilst the unforeseen risk in 2020 was a global pandemic, sustainability risk is a similar risk that many companies have been overlooking, which proved to be a dangerous approach. 2020 saw a shift in the way in which investors and institutions think about ESG factors and the way in which they impact their businesses. There was a greater focus on the social aspect of ESG, including factors such as employee health and safety, community relations, diversity and inclusion. The events of the year also focused minds on how well companies are being run in terms of their governance practices, particularly their dividend policies. It's led to conversations around how much money is being used to pay directors and shareholders versus how much is being reinvested to help employees and other stakeholders who are the ones truly reliant on the business. A spotlight was shone on the relationship between the way in which a company addresses these social and governance factors and how this translates into financial performance, as it became clear when markets came under pressure that companies factoring in these criteria demonstrated greater resilience and lower volatility in their share prices. The events of 2020 ultimately set the direction of travel for ESG investing and cemented its future within the financial industry as a matter that could no longer be ignored by market participants, from CEOs to investors, politicians, and regulators. Regulators have been one of the key groups to recognise ESG risks to businesses and have been extremely influential in driving the future of ESG investing. Sustainability issues have risen to the top of the priority lists of many world leaders and policymakers in all corners of the globe. And the push from regulators has placed this topic firmly onto the agendas of many institutions, particularly in the financial services industry. Europe has led the way in the sustainability drive, with the European Union announcing a Green Deal in December 2019, which aims to make Europe the first climate-neutral continent by 2050. It set out a number of targets relating to the reduction of carbon emissions, enhancement of forests, farming, green transport, recycling, and renewable energy. 3 of the global giants, China, Japan, and South Korea, also followed in Europe's footsteps and committed to net zero carbon targets. Whilst in the UK, Prime Minister Boris Johnson recently set out his 10-point plan for what was termed a green industrial revolution, which will create and support up to 250,000 British jobs covering clean energy, transport, nature, and innovative technologies. The European Commission is also finalising a taxonomy to define green assets, which is another significant step forward for ESG investing, as it would create the world's first classification system to provide a common language to understand whether an economic activity qualifies as environmentally sustainable, with the aim to boost sustainable investments and reporting. Regulation is pushing forward in Europe, with the European Securities and Market Authority having proposed changes to MiFID II regulations to bring financial advice firms into line with the EU's Climate Action Plan through the integration of sustainability and ESG considerations. EU parliamentary regulations have stated advisors should take sustainability risks into account in the selection process of financial products, regardless of the sustainability preferences of the investors. The Financial Conduct Authority, the UK's regulatory body, has also indicated that it will seek to mirror the European initiatives in ESG integration, with plans already announced by the UK government to make it the first country in the world to make large listed and private companies disclose the threats to their business from climate change by 2025, which will include banks, insurance companies, and pension schemes. Across the Atlantic, ESG has historically been a very political issue in the United States. However, the recent election of Joe Biden as president has positive implications for the future of ESG investing for this nation. Biden has immediately announced plans for the US to rejoin the Paris Climate Agreement and has put forward a number of ESG-friendly trade policies focused on limiting emissions and protecting workers, as well as domestic support for electric vehicle production and broad research and development for clean technologies. The US has a long way to go in order to catch up with the progress that has been made in Europe, which indicates attractive investment opportunities to be had as momentum builds and companies adopt greener technologies and infrastructure. It is clear that despite the rapid progress that has already been made towards full integration of ESG within investments, we are still very much at the start of a revolutionary process which is likely to change the face of investing as we currently know it. A flood of new regulations, plans and changes to laws are expected to come through in the years ahead, obliging individuals and institutions to make changes to their business practices in order to comply. Although adhering to tougher regulation and policy changes often feels like an onerous task, market participants can be reassured by the fact that they are being directed by the regulator into one of the key growth areas in investing for the future. So, with some careful planning and preparation in order to get ahead of the curve, investors and business owners can put themselves in the best position to capitalize on some of the key industries and trends of the future. Ultimately, ESG has a bright future ahead as it moves towards becoming the new standard of investing. So, perhaps it is not a question of what is the future of ESG investing, but instead it may be that ESG is the future of investing.